So you finally got that big win, a big year, and you have a significant lump sum of cash sitting on the sidelines. But now your second thoughts kick in. Is the market too high? Should you wait for a dip? That hesitation is the difference between a stagnant balance and a productive legacy. Data shows that time in the markets beats timing the markets every time. However, as a new investor, dropping everything at once is like hiking a ridge in a whiteout. It's a high risk, high anxiety situation. I get it. When you haven't built a buffer of gains yet, a 5% dip feels like a personal hit to your hard-earned principal. It's natural to feel protective of the base camp you've built personally or even corporately. You want the growth, but you also want to sleep at night too. In the next few minutes, I'm going to give you a professional deployment framework. We're going to audit your accounts, mitigate your risk through dollar cost averaging, and get your capital to work without the emotional noise. Let's map the trek. Watch my lesson on investing large sums. All right, guys, when we are considering investing a larger lump sum, whether it's something you've accumulated over time, a windfall, business profits, etc., there's a few very key considerations that you need to do before even thinking about the actual investment strategy. So the first thing you need to do is zoom a little bit back and consider not only the source of the funds. So are these corporately held assets? Does your business own this capital, or is it personally owned? If it's personally owned, have you already paid tax on it, or will there be tax liabilities down the road? So is it pre-tax or after-tax funds? You also want to consider what use of existing accounts have you already done? Have you already used? Are you maxed out on TFSAs? Or what about RRSPs? Have you ever used these in your personal accumulation planning? So you need to take a step back and figure out not only where the money is, but also what you have available in the investment or the kind of container or bucket landscape of Canadian wealth planning, so that we can implement and kind of, have a good lay of the land of which compartments are available to be funded by this initial deposit or lump sum or capital that you have to invest. Now, the next thing you need to consider is the length of time, like the utility and the time horizon. Is this something you don't need for a very long time? Is this all the capital that you have, meaning it's also your lifeline, your emergency fund? So do you have multiple potential use cases for this money? And if so, the way you invest it and which accounts you use to invest it needs to be taken into account. So these are two very crucial steps to take a step back and take a good accounting of where is the money, what is it going to be used for, when may it be used, and how have you been structuring your accumulation to date so that you can kind of take off on a solid footing. Now, one of the main reservations that many of my clients have when they show up and have a lump sum or a large sum to invest is the fear of losing capital. Hey, I have $500,000, but I know markets go up and down. I'm not sure if I'm willing to have that $500,000 be less than 500 in the short term, long term, etc. Right? The next thing we need to take into account is the psychology that surrounds investing. These are the mental blocks that prevent people from either investing altogether or that prevent people from taking the amount of risk that maybe they need to take in order to make that money produce the results that they want over time. And also the avoiding the trap of market timing, right? So a lot of people, they want to make not only good use, but the best use of this opportunity or this capital injection towards their future self that they're going to do. And sometimes when markets, the fear grips investors, certainly new investors, and sometimes investors want to avoid the inevitable eventual fall or pullback of investment markets. So initial investors feel these losses much more pronounced because this is money that maybe was never invested. There's not 20, 30, 40% of gain buffered into the first initial investment. So when you don't have any gains, which is capital that you have, but that's not really your money that you put in. So if you have $500,000 that you invested a couple of years ago, and it's grown to 600,000, 700,000. Even if that goes down by 100,000, you're still by maybe $100,000. But when you start with half a million, and then it goes down by $100,000, that hurts more because it's your own money that has like, in a sense, evaporated or gone down in value. So it's normal for investors to want to avoid the dips, but that involves market timing. That involves potentially waiting almost forever, because most people who wait don't end up investing their capital. They end up waiting and waiting and waiting. And when it actually goes down, which would be the perfect time to invest, they always think it's going to keep going down. So I've always said that timing the market is kind of like catching a falling knife. And to make it worthwhile, you have to catch it twice, really, right? So not necessarily when you're just starting to get it to invest. You only really have to try, in theory, all you'd have to do is try to invest before it starts going up again. But most people won't, because on the way down, it feels like the wheels are falling off. And most investors are very shy to throw their money into something that is consistently going down or has been going down, right? Our human nature makes us want to do the opposite. We want to invest more when things are going good, and we want to pull back from investing when things are going bad. But financially, you should be doing the exact opposite of that. So the key to investing a lump sum is to do it in sections. Just like hiking a mountain, you take it one step at a time. You can't actually 2-foot jump to the top of a mountain. And every mountain you're climbing has peaks and valleys. There's ridges, there's gullies, there's all these things. And investing is no different. So if we can acknowledge that investment markets go up and down, but generally have an upward sloping trend, what most people want to try to do is put their capital to work right at the bottom. But like I just said, that involves timing the market. And really, it's really hard to predict when markets will take a turn either down or up. All right. Advisors don't know. Portfolio managers don't know. It's anybody's guess as to when and how markets are going to shift. There's too many factors at play. So the key to investing a lump sum is called dollar cost averaging. And dollar cost averaging is simply the act of investing larger sums in smaller chunks systematically over time. So my key insight here is I usually go 6 to 18 months. So I will say, depending on the size and the kind of risk profile of the client, I will say, all right, you have $500,000. We're going to invest that over the next 10 months. So we're going to invest $50,000 per month. So what that does is you're investing through the peaks and valleys of the market. So if things are going well, the markets are going up, great. You're making money on everything you've invested. And when markets are going down, you're buying more of the same investment. So you continue buying through the highs and the lows, and that tends to average out, or sometimes even lower, your average cost of each unit you buy. So when you invest all of it up front, you encounter the risk of timing it wrong. You know, the main risk that people don't want to do is invest it right before it starts falling, because that hurts a lot. So if you invest it along the way, that's a great strategy. Sometimes if somebody's young enough and they have no need for the capital, sometimes we'll invest a part of it up front, because the earlier you can put money to work, the more chances it has to compound over time. Losing a year and a half of compounding can be significant to somebody's journey. So sometimes we'll do a big deposit when the funds are available, and then we'll take the other 50% or another proportionate amount and dollar cost average it. Investors really like about the strategy of dollar cost averaging is that not only does it bring investment into kind of a system, foreseeable planned system, but it also gives investors the chance to take advantage, right? So all of a sudden, a downturn in the market isn't such a bad thing compared to if you had put all your money to work and it's all gone down. When you keep some capital in your pocket available to deploy, when the markets go down, it's actually kind of a good thing, because not only if it goes down enough, the investor always has the choice to put all of their money into the markets at that time. So if we're dollar cost averaging on the way up, on the way down, and then on the way down, and it goes down far enough that the investor's like, this is a really good time. Markets are down 30%. I think this is a good time to put the rest of your money in. Like it's gonna bounce back, and the rest of your money will take advantage of this upward sloping swing. So it gives options. Investors really enjoy having options. Most investors dollar cost average naturally. I invest $1,000 a month, which means you're buying through the highs and the lows, and you're always buying. Lump sums, if they're treated as lump sums and there's no strategy involved, timing the market and the market swings feel a little bit more pronounced because it feels like there's no real action plan other than that first initial jumping off the cliff moment, right? But with dollar cost averaging, it's one of the best tools that we have in our arsenal to not only give structure and planning to a large investment or large access to a large capital investment, but it gives options so that you can be tactically taken advantage or have options, or at least not be left out of options if the markets do take a turn for the worse, which is usually the worst feeling. Usually the worst feeling is not having any options, nowhere to turn, right? Except for just hoping that it turns around. So in summary, when investing a large sum, it's very important to take a step back, work with an advisor to look at the full landscape, the full view of what has been happening, what is happening, and what you want to happen with this investment, as well as look at your options and consider maybe not doing, adding structure planning to deploy that capital. Instead of just jumping off the cliff, sometimes it's worthwhile to have an action plan on how you're actually going to climb this mountain, because the worst case scenario is when people avoid the risk and they don't deploy the capital and they don't end up pulling the trigger and investing. So having a plan, an action plan that gives you options, that gives you the confidence that a good plan and strategy gives you, it gets people to put their money to work in the markets for their long-term benefit and gains. Because for most people, putting your money to work in investment markets is one of the key ways to have your money grow, not only keep pace with inflation, but actually increasing your purchasing power over time. So if we've all heard the saying, no risk, no rewards, but sometimes risk can be mitigated, and using the dollar cost averaging strategy is one of the home runs of investment plannings. It gives us a bunch of opportunity to not only mitigate risk, maybe be opportunistic with investing large sums. Hopefully this was helpful. If so, please comment and share below. Subscribe to my channel to be notified of the next lesson coming up. And please share with your friends. I'm always here to help. And if you need advice planning for investing large sums, please reach out. I'd be happy to go through this process with you next time.